So, herzlich willkommen. Hinter mir klingeln gerade die Kirchenglocken zu 5 Uhr. Insofern denke ich mal, es ist ein guter Zeitpunkt zum Starten. Einige der Teilnehmer wählen sich gerade noch ein. Wir wollten trotzdem pünktlich beginnen. Insofern würde ich Sie ganz kurz alle begrüßen wollen zu unserem Webinar Private Equity in den USA. Wir freuen uns sehr über die zahlreichen Anmeldungen, von denen sicherlich noch ein paar jetzt dazustoßen werden zu unserem Thema, das wir mit unseren Partnern von Trimbridge besprechen wollen heute. Ganz kurz zum Ablauf. Wir werden einigen der Teilnehmern, die uns vielleicht noch nicht so gut kennen, ganz kurz nochmal skizzieren, wer wir hier bei Astorius und Trimbridge sind. Es haben sich eine Reihe von Bestandsinvestoren auch angemeldet, denen wir zum Abschluss nochmal einen kurzen Überblick geben möchten über die Bestandsportfolien, die wir in den USA aktuell bereits verwalten. Und einige der Partner, denen wir nochmal einen kurzen Ausblick auch über die Allokation und Entwicklung im Markt geben. Aber der Hauptteil ist der, den wir hier adressiert haben, dass wir mit unserem Kollegen Matt Petronzio von Trimbridge eben den aktuellen Stand der Dinge mit Fokus auf Private Equity in den USA beleuchten wollen. Wenn Sie im Laufe des Webinars Fragen haben, können Sie die gerne unter der F&A-Funktion eben reingeben. Wir versuchen die so ambulant wie möglich zu besprechen und adressieren. Sonst würden wir sie im Nachgang vielleicht noch eben beantworten, falls sie uns durchrutschen, aber gerne auch zwischendurch Fragen einfach reinstellen. Sie werden Zugang zu einer Aufnahme dieses Webinars erhalten. Also falls Sie sich vorzeitig eben verabschieden müssen, schicken wir Ihnen gerne den Link dazu zu, damit Sie im Nachgang auch noch dann den Rest mitsehen können oder das vielleicht auch eben Interessierten weiterleiten können bei Bedarf. Also, da würden wir die Unterlage beginnen. Ich werde unterstützt von meinem Kollegen Oskar Volkland, der sich hinter dem Kürzel Astorius versteckt, weil das Kürzel ist, mit dem er sich hier eingewählt hat. Nicht verwirrt sein. Das ist nicht Mr. Astorius, sondern mein Kollege, der auch für die Kundenansprache und Kundenbetreuung hier verantwortlich ist als Partner. Und wir werden begleitet von Matt Petronzio, den ich gleich noch kurz vorstellen werde. Das Hauptgespräch wird in Englisch sein. Ich werde die Einführung allerdings ganz kurz nochmal in Deutsch machen, im Sinne einer etwas beschleunigten Einführung. Oskar, kannst du dann die Slide einblenden? Für die, die uns noch nicht kennen, wir sind jetzt im 10. Jahr der Existenz. Wir haben 2012 uns gegründet, um unseren Kunden gemeinschaftliche Anlageprogramme im Private Equity des Small Mid Caps zu geben. Wir versuchen seitdem wirklich handverlesen Zugang zu Fondsmanagern zu geben, die sich in dem Bereich Small Mid Cap eben tummeln. Das heißt, das sind die drei Hauptstoßrichtungen. Was meinen wir mit gemeinsam? Wir sind mit über 10 Millionen Euro eigenem Kapital in dem Programm investiert. Wir versuchen damit den höchstmöglichen Interessensgleichklang herzustellen. Handverlesene Fonds ist bei uns wirklich ernst gemeint, da wir in einem sehr, sehr großen Universum aus kleineren Fonds uns seit 10 Jahren eben umtun. Und Small Midcap, uns ist klar, dass der Begriff des Midcaps gerne auch etwas zweckentfremdet benutzt wird. Unsere Beteiligungen spielen sich wirklich im Bereich der Unternehmenswerte von 50 bis 75 Millionen Euro ab. Und da versuchen wir wirklich einen Mehrwert zu generieren in dem Fokus, auf den wir uns hier eben konzentrieren. Wir haben es geschafft, in dem ersten Fonds, der nun die älteste, längste Laufzeit mit sich bringt, das eingesetzte Kapital nach allen Kosten zu verdreifachen, was uns sehr stolz macht, weil wir uns bestätigt fühlen, dass unser Fokus hier eben der richtige ist und unsere Arbeit eben zu Mehrwert führt. Damit landen wir, das sei uns mal verziehen, als kleine Marketing-Punchline in dem Top-3% der Dachfonds, die wir bei einem der größten Datenanbieter namens PitchBook seit 1979 eben finden, den Aufnahmen. Also wir haben ein sehr, sehr gutes Programm mit einem extrem guten Anlageergebnis für unsere Investoren eben vorzuweisen. Wir selber investieren eben seit unserer Gründung in europäische Fonds und wir haben auch unter Bedürfnismeldung unserer Investoren das Gefühl gehabt, dass wir unser Anlageangebot um den amerikanischen Raum erweitern müssen, da der Bedarf an amerikanischen Investitionen, auch in US-Dollar, bei unseren Stammkunden eben sehr ausgeprägt war. Und wir sind sehr glücklich, dass wir 2019 nach einigen Jahren der Brautschau mit Trimbridge einen Partner etablieren konnten, den wir so ein bisschen als unseren Klon in den USA ansehen, also der in der gleichen Geisteshaltung, mit der gleichen Zielsetzung, im gleichen Zielmarktsegment und vor allem auch mit der gleichen Fokussierung auf diesen Mittelstandsmarkt eben tätig ist. Trimbridge selber hat seitdem eine Reihe von Programmen eben aufgelegt und zu extrem guten Anlageergebnissen eben verwaltet. Das heißt, die Kollegen verwalten seit 2005 hauptsächlich für einen Versicherungskunden eben Gelder, haben dort über 3 Milliarden Dollar in den für uns relevanten Markt investiert, haben dabei über 100 Fondsinvestments getätigt und über 75 Co-Investments, was, wie Herr Volkland nachher noch sagen wird, gerade für unseren 7er Fonds, den wir aktuell einsammeln, auch nochmal eine besondere Rolle spielen soll, das Thema Co-Investments, und haben dabei das Ergebnis von 2,8 mal Geldmultiplikator nach Kosten und 20% IRR erzielt, was nach unserer Einschätzung eines der besten Anlageergebnisse eben für diesen Markt ist. Das nur kurz als Einführung. With that, let me introduce our common speaker, Matt Petronzio. He's partner with Twinbridge. He's now live with us from Chicago. It's an honor to have you with us to cover these topics. Matt has a career that started in 1996 with First Union Bank. So he has covered almost 30 years of investment through various cycles, various crises, and I'm very keen to hear your opinion on the current market environment. He's an expert in small mid-cap buyout and a member of the investment committee of Twinbridge. So thanks, Matt, for joining us, and happy to have you with us.
Thanks, Julian. It's great to be with you, and we're so appreciative of the partnership with Astorius, and we've done great things and look forward to many more great things in the future.
Matt, I've given you a couple of topics in beforehand that we'd like to cover. We've all been through various very interesting periods over the last 2 years with the coronavirus, with Trump, with Brexit. So the various factors that are unusual. The funny thing is that I had the impression that many Europeans looked on the other side of the Atlantic with this whole Trump era and tariff wars and trade wars. And now the focus has shifted over to Europe again. So we're very keen on hearing what your experiences have been over the last 2 years, what have changed, what has shifted, and quite punctually now, what is your opinion on what's happening in Europe over here? How does this affect you? So just take us through the whole last 2 years with Twinbridge and your investment experiences that you had.
That's a lot to cover in a few minutes, but so one of the benefits of being on this side of the pond is we're somewhat insulated. Obviously, we all went through COVID together, and the various trials that had not only on our personal lives, but also on our portfolio. Fortunately, I think in the United States, our experience with COVID was relatively muted and short-lived. The first few months when COVID and lockdowns happened, we certainly felt that personally, but in our portfolios as well. Many of the companies were closed or shut down. But the economy here was very resilient. I think due to both the economy already being in a good place, but then also a lot of support from the government. Within very short order, it rebounded. I think there were some surprises, like in healthcare, where you would expect it to be very resilient. Probably the most stable part of our economy. It was shut down. But within 6 months of the closures, volumes were back. People were seeing their positions again, and margins stayed strong. I think that a few spots in the US were hit especially hard, particularly retail. That's probably not dissimilar from Europe. But by and large, our economy is very strong and stable. And we were fortunate to really not have any long-lasting impacts other than the sort of long-term spend of the government to try to sustain us through this trial. Now with Ukraine, obviously that's been top of mind for everyone, and our hearts go out to the folks there. But the impact on our economy and our businesses and our portfolio has been de minimis, which is kind of, it's hard to, the dichotomy is hard to appreciate, I think, but I think everyone was very concerned when it first happened, right? And the threat that the Russians might roll right through Ukraine and threaten NATO countries on its borders. Now that that's sort of been gridlocked, at least, the concerns have abated here. And so it has not really impacted our economy. The ways that we are feeling it are tangential or derivative. And it's really perhaps in some wheat prices, though we make a lot of wheat here in the United States and in Canada, and in energy, right? So and it's the roiling effects of energy through supply chain and in consumers pocketbooks, right? So if people have less money to spend, it's certainly going to impact the economy. And that's being felt in our portfolios mostly through margin, right? So inflationary pressures on wage, inflationary pressures on input prices is impacting margin, and it's creating obviously inflationary pressures on price. And we're at a point now in the States where I think people have said enough, right? It's becoming a little bit painful. Our government is increasing rates. I think there's a 1.5% sort of projected increase in interest rates at the Fed funds, and that will serve to slow things down and hopefully counter some of that inflation. But by and large, I think we have benefited greatly by A, having a strong economy that was resilient through COVID, and then B, we have not really had a tremendous amount of impact from the crisis in Ukraine.
There's a lot to cover already in your answer. Just briefly, the funny thing is that during COVID, in hindsight, there has been a kind of a blip in transaction activity, given that we have a rising record levels of transaction volume and numbers. And there was a kind of break for 3 months in transaction activity, and then it took up again for the next year. So we're in the middle of this Ukrainian crisis, so it's not easy to foresee how this will gear up again when things might calm down. But how is this happening in the States? Is transaction slowing? How are the numbers on your side of the Atlantic?
Pace of transaction has been robust. There is ample capital, both from equity providers, private equity sponsors, and the lenders. So I would say transaction activity has remained robust. The first quarter of this year, we've seen a slowdown, okay? And I think that is due to several factors. Last year was very busy, and there was a rush here in the States to get transactions done by the end of the year, largely driven by potential for increased taxes, and that did not transpire. And then we expected that the continued pace of investment would be robust. It has slowed a little bit. And I think that is more to do with our own absorption of increasing prices, the interest rate sort of, forward look, the regime of 1/4 point raises every kind of 6 months. And so I think there's a lot of digestion happening right now. Purchase price multiples have not yet begun to recede. Leverage has not been taken down yet. We anticipate that some of that will happen. It's inevitable. If there is, if margins are compressed through all of these things that we mentioned, you would assume that purchase price multiples will begin to come back down somewhat. However, there is a lot of capital looking for a home. And so, there are many funds that are continuing to raise, and successfully so. So we think that we're kind of at a period of uncertainty, but there's still plenty of transaction volume. It's just not at the sort of breakneck pace that we've seen over the last 36 months.
And that's kind of a general statement on the market itself, but how about your funds that you work with? Do you see that they mirror this uncertainty in the way that they might slow down transaction activity, or do they represent the market in general?
I couldn't tell you exactly why the market has slowed, nor could I say exactly why our sponsors are calling a little bit less capital. But I think it's a time for prudence and caution, and for our managers in particular, who are typically cycle tested, very experienced investors that have been through other crises before, to take stock of all of the things that they know and those things that they may not know, right? And so that prudence that is expected, thinking about forward earnings, right, is a concern. And on the other side of that coin, sellers are going to be mindful of can I still get the price that I thought I could get 6, 9, 12 months ago? So there will be a little bit of friction as prices begin to come down. And that we want to see discipline on the side, on the part of our private equity sponsors, and the ability to find less shopped proprietary opportunities in the spaces that they know well. It's really about partnership, right? They're typically not buying in auction processes. It happens sometimes, but more often than not, they're in direct dialogue with a founder or an entrepreneur who is looking to make a change, whether that be to sell or to partner. And so the dynamics around that are consistent. And if our great sponsors do the job that they should, they're still finding great opportunities at very attractive prices, not using a lot of leverage. So typically over-equitized, which also provides downside protection and flexibility in case there is some dislocation over the next 24 months or something. So that's a long kind of meandering answer, but I think that the key is manager selection, investing with folks that are cycle tested, that have been through hard times, that don't use leverage, and make sure they preserve flexibility in their portfolio companies. If they can continue to buy companies in the types of industries we like, consumer and products and services, healthcare services, tech-enabled services, light industrial, those are businesses that are the core of the US economy. There's plenty of opportunities, and they're the best buyers of those assets. So we think that the future, at least the next 24 to 36 months, notwithstanding any other extraneous global macro events, it should be very consistent with the way it's been in the last few years.
Okay. Well, we have a couple of clients who now shift their focus on the United States market, given the environment in Europe right now. So we had to go through all the 200 portfolio companies that we own indirectly, and we discovered that we have hardly any impact in terms of supply chain or in terms of sales markets. So we have a very limited direct effect, but nevertheless, we're still in Europe, so we have to cope with that. So the interest is increasing in allocating to the States. Do you share that opinion that people are even more looking towards you in terms of fund investments? The appetite for American small mid-cap?
I think it has been robust for a long time, and it remains so. If this is any indication, all of the funds to which we have made commitments have been raised not to their target, but to their cap. So they're having, because of their unique and differentiated value proposition, because of their performance, the investments are attracting surplus capital for the needs of the funds. Similarly speaking, we have seen a lot of investor demand for our funds domestically, where we will be raising near our cap. So I would like to say that it's just us. I think the whole US private equity market is attractive on a relative basis. The fact that we have tens of thousands of small companies that are founder-led, entrepreneurially owned, and many of those, there's a generational shift similar to in Europe, where entrepreneurs need to do something with their companies, right? If they don't have family members to sell to, they need to find liquidity, and that's continuing to create lots of opportunity. And so, yes, there's a lot of demand for what we do. It remains consistent, and it's moved from institutional investors all the way down to retail investors. Now, we offer an institutional product for high net worth and family office clients, similar to what you guys do in Europe. But we've seen more demand, not only from institutional, but from lots of high net worth, family office, RIA type investors as well.
So Matt, maybe if I jump in here. So basically what you were saying is that we've come out of a period that was for a number of years now almost too good to be true, let's say. And looking back at the 30 years that you've been doing this, we're now sort of coming back to the old normal, let's say, where you basically had issues that capable managers were mandated to solve, basically. And so we're definitely not in a state where people should try to sort of market time their way around this phase where, well, there's basically just some normal level of uncertainty back into the markets that has been normal forever, say for the past few years of anomaly, let's say. Is that fair to say?
Abundantly. Yes, I think that one of the risks in our industry is that people try to time. And I know many investors institutional investors over the last 5 and 6 and 7 years that have said, oh, we'll wait because the prices are too high, or it feels too hot right now. And they missed a tremendous opportunity. Our expectation, our philosophy is to invest in the very best managers when they are available, because when they come back to market, you must invest with them. And if we do our job properly, which is to build diversified portfolios with experts that can really provide you the unique exposure to the best parts of the US economy, there should be consistent performance. But you can't jump in and out. It needs to be thoughtfully constructed, a portfolio approach over multiple funds. I'm sure you talk about this with your investors, where our funds, for instance, provide 3 years of vintage exposure, right? And the funds that we provide through the US funds similarly. And that mitigates J-curve risk. It mitigates vintage year risk. And it should provide that buffer over time where investors can get a consistent return by being disciplined and consistent in their investment philosophy in this product. Again, the variability in our returns have been pretty tight through cycles. And it's been a great time over the last several years. But we expect that, again, if we follow the philosophy that I just laid out, those returns should be consistent regardless of what lies in store for us, which we don't know. But portfolio construction, manager selection, and consistent deployment in good times and bad will generate consistently good returns.
How about we take a look at how that works in practice, and take a look at how our first joint project has come together since we laid the first seeds in the ground in 2019. So we closed our first fund, ACF V, that you select managers for on the ground in the US. We closed that in 2021, and so what we're looking at here is that, well, we have a nice rounded portfolio of 9 GPs. We have some first-time funds, some second-time funds, but we also have a generation 5. Maybe just walk us through the portfolio. I know you've been at the Blue Sea AGM last week, so anything of note, or help us understand how you put together a portfolio like this and the combination of managers that we're seeing here.
So again, a lot that goes into that, but you should feel very good about this roster of funds. These are very, very strong, highly sought after private equity funds in North America. Many of these we've had long-standing relationships with and are access constrained, and we were able to get good allocations for Fund 5. We wanted to be thoughtful about the portfolio construction. So you're going to have consumer and healthcare and industrial, business services, and technology. I think it's about 20% consumer. At least the underlying portfolio exposure will be sort of 20% consumer, maybe 15% healthcare, 25% tech, 10 or 15% industrial. So it is over multiple vintage years and with really high quality managers. I think it's important to, you mentioned, Oscar, that there are some first and second time funds. We describe them as next generation managers. We don't describe them as emerging, and there's some important distinctions there. These are teams of professionals that have been working together for a long period of time, since in some cases 20, 25 years. They have deep and clearly attributable track records of success doing exactly what they're doing in their new funds, the same as they were doing in their prior fund. What's more, they've taken the leap from an employee or part of a bigger team to be entrepreneurs for themselves. That's a great alignment for the limited partner and for us, because they have their reputation on the line. They have the lion's share of their capital at stake. And we have found that over time, this is an excellent time to invest. That asymmetry of capital and experience is very, very compelling. So, Clearhaven, for instance, is a tech-enabled services and software fund based in Boston. Michelle Noon, who is the founding partner there, brought other partners from their former fund, Riverside Partners, where we were an investor, and have the exact strategy to do what they had done before. And they're off to a fast start. And Blue Sea, you mentioned, Blue Sea is a relationship that my partners and I have had since the 90s. They were at a firm called Brockway Moran, which is a very long-standing and successful private equity fund based in Florida. They spun out in 2013 to form Blue Sea. They already had a 10-company track record that now today is worth more than 4 times money. They do aerospace and defense, healthcare services, and light industrial. They're about to raise their 3rd fund, which I think will be considered for Fund 7 as well. And their performance has been so far very strong. But with funds like STG, you get technology. With Stride, you get consumer. And then the other funds tend to have a little bit more of a diversified approach. But we're very proud and pleased with this portfolio and think that investors will be really well served by it.
Excellent. Would you say it's fair that it would have been next to impossible if we had tried to call up most of these managers on our own from Hamburg and knocking on their door and had tried to get in there? You mentioned you had relationships going back to these managers, sometimes back to the 90s. When you look at some of those managers who are not billions and billions, but a couple of $100 million, it would have been tough if we had tried to come in on our own, right?
I believe you're capable of anything, Oscar, but
sure.
But there's something to be said for knowing your market, right? And this is our addressable market that has 900 or so funds that are available to us for investment. Not all of those are in the market at all times, but we make it our goal to be in contact with all of them. We have a very comprehensive scoring model and addressable market that looks at all of the over 100 quantitative and qualitative metrics to assess those managers that we think are best in class. That's fine. You can identify who those are, but then getting access to them is another story, right? So spending, in some cases, years to court them, to see how they execute their business, to make sure that they're high integrity, good quality people that do what they say they're going to do, and that there's an actual spirit of partnership, right? That they want to have us as a part of their fund, not only for our capital, which is the same as everyone else's, but also our expertise and our co-investment capabilities. It would be hard for me to come to Europe and build a portfolio, and we would rely on you similarly, right? So this is what we do, this is what we know, and access to those hard to access managers is key to building a great portfolio. So thank you for that.
Well, thank you. And you mentioned now co-investments a couple of times. If we look now at the new fund, Fund 7, we introduced structural novelty, as in planning to allocate 20% of the portfolio to direct co-investments, which we haven't done in Fund 5. And I think we're off to a good start on the co-investment front. Maybe if you look at the fundraising year 2022. I think both in Europe and in the US, you're expecting a lot of re-ups from existing managers. Do you see other trends in the market in terms of sectors or business models? What's the outlook for Fund VII? Maybe touch on the two managers that we already have allocated to. So people who are either already invested in Fund VII get some color there, or people who are considering get a feel for what they might buy into.
Sure. Yeah, we're excited about the opportunity to have you participate in some co-investment. I think that will be a really unique and compelling attribute to the portfolio, not only from the diversification, but also the alpha potential that comes from it. You have listed here that we have two co-investments pending that we expect to close here in the next week or two. And I'll give a little flavor on that in a second. But I think that there's sort of a tale of two cities right now in terms of the capital raising in the United States. There are too many funds coming back to market than investors can address. Okay, so what that means is asset allocators like Astorius and like Twin Bridge need to focus our attention on those investments that are best of class and where we must have them in the portfolio. I think we have 11 or 12 re-ups for 7 spots in our flagship fund. So there's some hard decisions to be made. We're trying to defer or push managers off to 2023 where we're able. Unfortunately, many of the managers that we invest with have the ability to raise quickly. So we're really struggling there. But fortunately, we're still able to get great allocations for Fund VII, thanks to our relationships. So Main Post Partners is an example of a fund that's been around for now quite a long time. We invested with them when they did first spun out of their former firm, Weston Presidio. They're a consumer products and services focused fund based in San Francisco. And they have exceptional returns, truly, in many brands that folks on this call would know. And that is a fund that we were able to get an allocation for Astorius, due in large part to our relationship with them and the trust that they have in us. And we've actually co-invested with them in several opportunities that have worked out very well. Rainier Partners is sort of at the other end of the spectrum. This is a next generation manager. This is two gentlemen that not only, I think they finished first and second in their high school class. They finished first and second at Dartmouth College, and then they went to Bain Capital together. I mean, it's a little bit scary how closely they've been together, but they are incredibly bright, incredibly accomplished. They worked together, as I said, at Bain, and then at Altamont Capital, and then it won at Gemspring Capital, came back together to form Rainier, which is focused on investing in the Pacific Northwest, principally. And we really like the humility and the sort of experience, again, that asymmetry of experience to capital that Rainier brings, and especially their focus on the Pacific Northwest, which tends to be a little bit underserved for private equity. So a really nice opportunity to get in with another next generation manager. These guys have 10 or 15 years experience in doing private equity. So they're not new investors, even though it's a first time fund.
And how big is the raise, or how big is that fund?
They will raise about 250 million US. So, and they're actually accelerating now in terms of their fundraising. Now they have a couple of portfolio companies in the fund. Investors are really starting to embrace it, and it's moving kind of quickly now. And we anticipate there to be co-investments that come from that investment. The two co-investments that we have pending are in really attractive businesses. The first is a company called Polara. I know you don't have the names here, but it's a company that does, it's an original equipment manufacturer focused on the infrastructure space in the US, specifically traffic management systems. So technology around crosswalks and other sort of places where pedestrians are crossing roads, everything from handicap accessible, but it's really there's a huge push in the United States to develop infrastructure, trillions of dollars being spent, and this is in the path of progress. And it's also the intersection of what is kind of boring traditional infrastructure, blending to Internet of Things, applying technology to manage the traffic systems from a central location. This is being sponsored by one of our funds, Van Street, that we've had several commitments to. And there's just a lot of opportunity in this space to add that technology and also add other businesses, buy and build, to grow this to be a real leading business. The second one is partnered with North Lane Capital. And North Lane bought a company called Infobase. It's basically educational, video on demand, reference materials, career services, all offered via cloud. So it's a very low ticket, sort of anywhere from $1,000 to maybe $50,000 for schools and universities and corporations. It's very recurring, very profitable, and it's a small cost. So it's got very, very high, sort of maintenance of contract, right? They don't have a lot of churn because it's an important way, especially through COVID, for students who are working remotely to access research materials and academic materials. And it's a very small cost for the university or the employer. So, it's a 80-year-old company, used to be very sleepy, kind of traditional books and that kind of stuff, but now has been converted to a digital first model. And, that most of their content is proprietary. They do some licensing, but we think it really is, similar to Polaro, which is in the path of progress with infrastructure. This is in the path of progress for education and online learning, continued learning, and with a sponsor that has great expertise there. So two nice ones to get started, and we hope there'll be several more to come.
Excellent. And we're probably in the 80% pocket of funds. We're looking again at 8 to 10 managers that will be complemented by the co-investment portfolio as we continue to build it out.
Right.
So yeah, excellent. Let's see if we have questions from the audience, and if we don't yet, then we invite everyone to post some. Let's see. Well, actually, I was speaking to one of our investors yesterday, and he was very concerned about the outlook on inflation and rates, and wondering, for existing investments that are financed, I guess, mostly floating in the US as well. Like, what are you expecting to see there with inflation, running up to like 7-ish% or so, and some people saying they might see, Fed going up to 3.5% by year end or so? That might be a bit extreme, but coming out of a period where financing seemed to be almost free, what do you expect to see in existing portfolio companies, and perhaps in different segments of the markets, from your home turf, small buyouts, through the mid caps, and then into really the larger deals?
That's a good place to start. It will impact larger companies far more than it will small ones, right? They are much more reliant on leverage to a greater degree for their acquisition and also for their value creation, right? Financial engineering tends to be a little bit more relevant in the larger part of the market, not necessarily where we play, right? So most of the businesses that our private equity funds are acquiring tend to be lower leverage than would otherwise be available to them. Again, preserving flexibility to make acquisitions, to add management to enhance their technology systems, et cetera. You know, especially in small companies that could be a little more fragile, providing them flexibility. Now, I don't have a crystal ball, but I would have to say that it's expected that floating rates, especially on revolvers, will be increasing. Most of the long-term capital is fixed, right? So if you have term loans, they're fixed. And it was probably a good time to lock in some low rates over the last few years. But it's inevitable that the price of capital, debt capital in particular, will be going up. Most of the businesses that we are investing in have high gross margins and high EBITDA margins and a lot of recurring revenue. So debt service and interest coverage is typically very manageable. That said, at the margin, some businesses, particularly those that are more capital intensive and maybe a little more project-based, episodic, will be impacted more so. It's important, I think, you have this appreciation, Julian and Oscar, that we've been living in a world over the last 10 or so years that is not realistic from a rate perspective. So getting back to 3 or 4 or 5% interest is healthy and is probably appropriate. We joke around here that some of our peers that work with us in their early 30s have never paid any interest. They've never had a car loan that actually charged interest. It does have an impact on purchasing power and how much you can actually spend for your dollar or euro. So it's we don't think it's a problem yet, but it would be naive to think that if rates keep going up, there won't be an impact on interest coverage and debt service capability, which again ultimately translates to less capital, lower prices, and the typical cycle that we would see in normal times.
Yeah, so good. We're at our end of the market where there is typically much less leverage and much more opportunity to not depend on financial hocus pocus and grow companies organically and increase margins and so on.
Absolutely.
Very good. So it looks like you've answered everything that
we did such a good job
had on their minds. And so we can actually be crisp and on time. And yeah, well, if there is nothing that anyone else has on their minds still, then yeah, well, thank you very, very much, Matt. As always, that was very informative, and it's good for people to, put a face to the name. People have put their trust into the concept of Twin Bridge without really having seen much of you guys. And so it's great to be able to relate as we go along into the years that we'll be partnering. And there has arrived another question. And yes, we can share stuff via email. Or actually, we will record the material and we will send the replay to everyone, so you will have access to that. So yeah, well, thanks everyone for joining. If there is any interest in following up, please reach out. You can find our info on our website, or most of us will know us. And so Fund 7 is 50% spoken for, so it won't be around forever. And as you heard, there is an attractive opportunity to diversify away from Europe into the US. And yeah, well, we're here, Matt's there, and we do what we can for all of you. Thank you very much and have a great evening, and you have a great rest of the day, Matt.
Thanks, everyone.
Thanks.
Appreciate it.
Bye.
Have a great day.
Thanks, everyone.